All right, welcome in everybody. I know we're starting to trickle in here. I'll give it a couple seconds to catch up so all of you can join. So I'm not just talking to myself. But welcome to our first edition of the AI Circle for April of 2024. Feels like it was just yesterday that we were celebrating the new year, and now we're over a third of the way, or pretty close to a third of the way through the year of the market. So we have a lot to cover today, a lot of new things. We've gotten a ton of questions about the new BitFlip Smartfolio, so I want to just honestly kind of dive right into it and welcome Mr. Kelly Korshak in. Kelly, how are you?
Hello, everyone. I'm fine. Hopefully, everyone out there is doing the same as I am today.
Yeah, I'm sure. It's a great week. I know you and I both like golf, and it's the Masters this week, so makes it for a. I'm jealous of all the people that get to go to that this week.
I'm
um,
jealous of any time I watch a pro.
Very true. I could second that as well. I'm just gonna pop the disclaimer up real quick, and then we'll get into the agenda. And I know, like I've already said, we have a ton to cover today, so let's just dive right into it. So first things first, we do have to get the disclaimer out of the way. So iFlip Investor Inc. and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure that the iFlip Smartfolios that you select are suitable for your investment profile before trading in a live brokerage account. With that being said, because and I say this every time, but we do truly have new people joining us every single week. So this is kind of our agenda here. We're gonna, and we might switch this up a little bit because of all the bit flip questions, but we'll usually spend 10 or 15 minutes talking about the market with Kelly. We'll go over any recent trades that the AI has made. After that is the Q&A, which is your gateway to the Amazon gift card giveaway that we'll do at the end. And just as a recap, we will pick what we think is the best question for the night, and we will award someone a $25 Amazon gift card. So, Kelly, I'll turn it back over to you. Like we've already said, there's a bunch to cover, and I'm not sure exactly where you want to start, but feel free to dive right in.
Well, I think, first of all, hello, everyone. Happy Wednesday in April, and we're past April Fool's Day. There's a bunch to go over, so I'm going to go over it the best I can and as quickly as I can, because Q&A seems to be the most important thing for most of us out there. Sorry about the phone. And I wonder that even happens on regular TV these days. If everybody can, if they're looking at the screen, hopefully, and not at me, that's a picture of the Dow Jones. I want to show you a picture of Bitcoin. So let me start with that cryptocurrency. All right, everybody should see Bitcoin. Okay, so we have a new Bitcoin portfolio. Currently, for those of you that are out there, it is 50% in. Remember, our idea of this portfolio is to be long Bitcoin through the proxy, the tradable proxy called IBIT. IBIT is just an ETF that buys Bitcoin. That's all it does. It's efficient and we like it. We are 50% in. Our core position is there. Anybody that has joined it since we've launched it, which is only maybe 4 or 5 days ago, the pricing is probably very similar to what you see today, where IBIT is priced just under 40 bucks. Bitcoin trading right now at 69,700 approximately. It's not aftermarket. Bitcoin has its own hours. It's 24/7. So what's important about this is that this system will either be, and so we all understand it, it'll either be, always will be long 50% in Bitcoin, and sometimes it'll be long 100% in Bitcoin when our modeling says to go be in the market as well with the other 50% of the money. So we're either long 50% or we're long 100%. Most of the time when we're in the market, We are trading momentum. We're trying to be in there for a move to the upside. However, if the market falters, which this market does frequently, we want to be out of the algorithmic side and just in on the core side. So I think if you can understand the portfolio, it's essentially 50% cash and 50% Bitcoin, or just 100% Bitcoin. It is possible that we could get a trade in the short run to be 100% long Bitcoin. As you can see, it is just off its highs over here, literally just off its highs. I suspect that we will be long Bitcoin sometime within the next month, and sometime hopefully by the summer. I expect Bitcoin itself to be around 100,000. The cadence of this algorithm ownership concept is very, very good. It is really just designed to say if Bitcoin turns out to be a bust, we would essentially, if everything works the way we expect, we would lose half our money. In other words, Bitcoin goes to zero, your portfolio goes down to, your $100 goes to $50. If Bitcoin goes to 100,000, you will make half of that because you only have half Bitcoin, but we hope the other half will also participate in that upside, and we will make money when we're also long systematically. So it's a way to hedge our bet. Think of it, another way to think of it is if it goes to $1 million a coin, I'm not saying it is, then we would make $500,000 at least, because we're long 50%. And then if we assume that our model even just broke even, because it's really largely there for protection on the downside and momentum on the upside. If it just broke even, you would make just half of that. But that's worth it if you think of it that I have a hedge in case it doesn't go to 1 million and it goes, unfortunately, much lower. And it has done that, as we know, at least 2 times before. So let's hope this move actually has continued legs. So that's it, what I'm going to speak to. There's nothing really much to this portfolio. It's pretty straightforward. We're either in 100% or 50%. Right now it's 50%. Now we're going to go back to the markets real quick. And I'm just going to run through the markets and tell you what the AI has done to a couple of portfolios just literally this week. Well, let's look at the Dow. Always important. The Dow is sort of our bellwether. I don't like the index. Most people understand why. It's because the index of the Dow is just 30 stocks and it has got poor weights. I mean, what on earth is Salesforce.com doing in the Dow? And I even rationalize, what's Goldman Sachs doing in the Dow? I mean, I get the banking sector, but Goldman is small relative to JP Morgan. Doesn't hire that many people. Doesn't make sense to me. But I know why they do it. It's because they want the index to go up. And Goldman has been a good bet, except today. Let's take a look at where the market is year to date. So for everybody's edification, is the market has had about a 5% correction, literally over the last 7 trading days or so. Here's where it was, just under 40,000. It couldn't get over it. Now it's backed off down to 38,480 or so. I'm sorry, my eyes are not good to read. And we came into the year, again, so we understand, we came into the year right around here, which was 37,655. And that means we're up only 4% in the year on the Dow. Seems like every day the market goes up and there is a bid underneath the market. If you can see these candles, you'll see this to be true. If you look at any of the red candles, you'll see that most of the volume is towards the higher end of the candle. And the settles, the closes, are generally towards the higher end of the candle. And that means that most of the volume is way off the lows. In other words, if there is a low, it's generally occurring on the open, actually, as it did today. And the market buys that open. In other words, we are in the mindset in this country, at least in this country, to buy the dip. And that will continue until one day they buy the dip, it doesn't work, goes down lower, they buy the dip again, and it doesn't work. And then when it goes lower one more time, they won't buy it and they sell. And that creates a correction. Right now, this doesn't look like a correction to me. We're still up 4% on the year. We're well off of 2 standard deviations above a long 200-day moving average. It's always good to reference a 200-day moving average. And so this is the biggest correction we've had for the year. And frankly, the biggest correction since literally last November. But if we look at the S&P, well, lo and behold, we're only off maybe 2.5% here from the all-time highs. This correction looks very similar to previous corrections. Really, not that much. This isn't really a correction. They are buying the dip. There's an example again of a candle where the little red part was no volume. The trade today was the low was achieved early, market bounced, and then it stayed in a tight range where all the volume occurred. The only way this market corrects is if we can break through this recent low that we had on that one sell-off day, and we can move down to be down at least 5 or 6%, which would be the first Bollinger Band on the 200-day. And this is starting to show up in our machine learning. For example, this week in the balanced portfolio, we got out of McDonald's, Burlington Northern, and United Health. And I would challenge anybody, if you go look at the charts of any of those stocks, you'll see why we got out. And right now we are basically on the lows of the week. So this is the first time I've sensed a modicum of selling. And in a way, this is a good thing, especially if we can correct a little further. It will create other opportunities especially for our machine learning component, to maybe rebuy those stocks or buy other stocks. But right now, machine learning is signaling a decay for sure. And that's when I sold those 3 stocks. The balanced portfolio contains 20 stocks, and that means 15% of the stocks were out and moved to cash. So we have the cash position there, and we also have a cash position in the S&P still. So a correction would actually give us the opportunity, hopefully maybe to rebuy those things at a cheaper price. Or if we correct further, we might lose some other stocks, but we would pick up the S&P. So that would actually be good. But what's causing all of this recently is real simple, folks. Here it is, the bonds. This is the 10-year note. Today was a massive sell-off. This is a very big move for interest rates. Why? As everybody knows, inflation has really rocketed higher. And it's not just oil and gas. It's core inflation, not the transient one that the current administration loves to talk about. Things like oil. Like oil is temporarily down. Well, I got news for people out there. It's only April and summer hasn't begun. We know generally during the summer, energy prices tend to rise in anticipation of more use of energy in the coming months. But it's already only April, and it's already happening. There is something afoot here. This is not good news really for housing, or at least new mortgages. So the housing builders today were all down. The Toll Brothers, Pulte's, KBs, they were all lower by 4 to 5%. These interest rates make it very difficult to buy homes. I think most people understand that. We are now sitting at about a 4.48, I think, 10-year note, and the 30-year actually hit 5%. That's the highest it's been in quite a while. You can see we're off now, moving down to our lows. This is something I anticipated, but the stock market still refuses to understand that there will likely be no interest rate cuts this year. We were expecting 7. I suspect we'll get none. And the market will have to digest that in an election year. And for now, I'm nervous, but we have AI and it's already starting to show the decay and manage our way out of certain stocks to reduce our risk. And that's all we can do. We don't prognosticate the market, but we do prognosticate future risk. And if future risk is higher, we want more cash. It's as simple as that. In the bonds, as you can see, this last bar on the chart is a big one. That's a big move for the 10-year. And I've seen some big moves in the 10-year, but that was the biggest one I've seen in a long time, literally since the bull market began. If you think back on it, last November, look at this. Here's a green bar where we saw huge volume. This here tells me we could, with the producer price index, probably have a little more decay, which generally comes out tomorrow. So let's see what that shows. But in contrast to all that, I think it's worth noting, look what's going on with the energy stocks. Let's look at ExxonMobil. Pretty clear, inflation is going up. This is not core inflation, by the way. This is just this is the commodity-based inflation that we're kind of understand. Oil prices go up and down, but right now Exxon has made new highs, and its dividend is no longer 8%. It's more like 4%. That's why, as you all know, I've been a huge bull on these stocks, Energy Transfer and All Plains American. They have corrected, but they're correcting as we move into dividend time, which I expect. And these are things to be bought, not sold. And we made absolute huge new highs before the last 2 days in anticipation of the next dividend. They've pulled off. And here, as you can see, it was earnings anticipation they're expecting. There's going to be an event. So I like these stocks. We will buy any dip. But either way, if you own it here, or even if you owned it at its high, it's still a good buy. And this has been a big component of our red oil. Exxon, Energy Transfer, Exxon, All Plains, and even the XLE, which of course is this. So we're long all of these things, and they are working, folks. So congratulations to those that own red oil. I think it's worth noting some high dividend stocks. They have pulled back. Here's a stock I do like. It's Verizon. We came off of a pretty good high move, but guess what? Why would we come off so much? Well, look down here, folks. This is called a dividend. When market is about to pay a dividend, it goes down. If you look at it, here's a dividend. We move down into dividends like we did here. Why? Because this company is going to use cash off its balance sheet to pay a dividend. And that means that the money goes back to the shareholders. And as we get the money back, they have to take it from their balance sheet. So they adjust the stock price, generally co-measure it with how much their dividend was. And then right after a dividend, things tend to rally. Like here's the case here. We paid the dividend, we came down, and then we rocketed back up. So you always can expect right prior to dividends that there will be some selling. That's very normal. And that's actually how many dividend strategies work, is to actually get out prior to the dividend, not even take the dividend, because they know that the dividend will just move the price of the stock lower. Maybe you buy it 15 days before the dividend and you sell it maybe 4 or 5 days, 5 or 10 days later to capture that part of the anticipation of the dividend. So that's actually a given strategy done by many mutual funds that actually are dividend capture ideas. What else here? Let's look at the spider. Even though we see the S&P index, if I were to just look at this as a chart, I don't see any decay in the market here. I just see that it's at the lower end of a range. But if I wasn't looking at the bond market and I wasn't looking at some of the other indices and stocks, I would be remiss, because the stocks are telling a different story. And I'll give you an example. Here's the Russell. Here's the beginning of 2024. Russell is flat on the year. So for such a strong stock market, we've just retraced 2024 profitability at this point in time, at the beginning of the second quarter. My instinct is here, forgetting about AI, is this market probably has a little lower to go in the short run. It'll do so begrudgingly. It takes very little news to make the market go higher, and it takes big news to make the market go down. And even when it does, people will still buy it. It's just as it aggregates, if these interest rates move even a little bit higher, this will wear down the buy the dip traders. And eventually they get punished. They always get punished. And when they do get punished, they lose much of any previous gains. So I like this kind of scenario. I kind of feel like that I know this. And the good news for us is since I can't control things, I'm seeing our machines do the things that I would hope they would do, which is give us predictors that say we're moving down, and that's what we're getting. But not all things are moving down, and we can just look at one of them. Here's Meta. That sure looks like Meta today was up, even though the Dow was down 350 and the S&P lost almost 1%. It's close to its highs. This sure doesn't look like anything here should be sold. And why is that? It's the same reason that if we look at NVIDIA, which was also up today, why? Morgan Stanley says, oh, we should own it. But the investors yesterday, before Morgan Stanley wants to give a buy recommendation, were willing to sell it. And Morgan Stanley itself, with its call today, kept this market alive. But no, folks, this thing is going lower because it's just time. You can feel, I can feel this. Feel means nothing in what we do in this company. It's math, and we will stick to that. My feelings mean very, very little, and that won't hurt my feelings. Pun intended. All right, let's move to the dollar real quick. Nothing going on. Perfect. It's in a perfect range. Nothing is happening. Everything is kind of steady. All currencies aren't really moving. The market has calmed down. The dollar has no influence right now on where worldwide capital flows are going because it's all understood. But the totality of the markets are the dollar. I get it. We have two wars out there. We have a lot of unrest, not just in America, but it's all over the world. These things do aggregate, and eventually they manifest themselves into something generally that's not good. And let's just hope that it drags on so we can move more and more cash, because one thing is for sure, they may drag on, but the market has the ability to really surprise people, especially bears, people that are bearish. It has this huge tendency to surprise them and say, you know what, you don't think I can go up? Well, I'm going up. The market has a mind of its own. And I think its job is to inflict as much pain on everybody it can. And with both longs and shorts, both have equal amount of pain. So on that, I think, Lee, we can move now into some Q&A.
Well, perfect. That was great. I just wanted to stay out of your way and keep listening. I'm going to go first. We had a couple pre-submitted questions, and Suzanne actually added one, but where was it? So this was the first question. I paraphrased a bit, but she basically said, I'm imbalanced and aggressive. I want to move some cash into the BitFlip portfolio, but I remember that we were going to automatically invest into BitFlip in those two. I think this is regarding the 1% and 2% or 2% and 3% of iBit that were added to those two smart folios. So would it be in my best interest to still add BitFlip? I think there's an underlying question here as well, but go ahead with your answer first.
Well, first of all, if you had nothing else, having 2 or 3% of Bitcoin is a good bet in anybody's portfolio. It has replaced gold, and maybe I'll talk about gold before the AI circle is over tonight. The reason you put a small amount of capital into a non-correlated investment, and we can debate if Bitcoin is non-correlated to the market or gold is non-correlated to the market. But let's just assume for practical reasons it is. The reason you want it is if the market goes down, you want the non-correlated asset to protect you in that case. That's always what it's been with gold and or just bonds, right? Bonds are non-correlated generally to stocks today. You see the bond market moving down, but you see the stock market is generally still moving up. Yes, I do think it's valuable to put a portion of our portfolio in the BitKit strategy. Why? Yes, it will create more exposure totally to your portfolio in Bitcoin, but it's also a strategy. And it's not Bitcoin in our portfolios is just, in our case, I've added it as a buy and hold because we're making a longer term bet to decorrelate the entirety of a portfolio. So we don't use an algorithm on that inside of our balanced and aggressive. We want that holding out there to remain to manage the downside risk of the stock market. And by the way, if they both are correlated and they both go down, remember, it's a small percentage, 2, 3%. It's not going to make that much difference. If that 2 or 3% lost 15 or 20%, it would still not damage most of our portfolios.
Right.
So if I had $100 and I had $50 in aggressive and $50 in balanced, what is wrong with selling 2.5% of each and putting $5 of my 100 in the Bitcoin strategy? It has a lot of opportunity if Bitcoin goes up, and it will manage risk very well, I feel. That's what all indications are. Past performance, of course, not indicative of future returns. And that's always understood, I believe, with all of our community. But if you did that, you would have approximately a 5% exposure with Bitcoin there, and you'd have another 2% of exposure, say, or in the aggregate of your balanced and aggressive portfolios. So yes, you would be biting off more Bitcoin if you took a 5% allocation and put it into BitFlip.
Sure.
But think of BitFlip kind of as a little bit of a gamble. It's not a decorrelated thing. It's a gamble. It's worth no more than 5% of your portfolio if that portfolio is designed to create and grow over time. Then it should definitely help there. But if you're at the casino, it's a different thing, and it becomes more of a bet, and it's going to be highly volatile, folks, as you can imagine.
Sure. Along those same lines, not to jump around too much, but sometimes I get asked about using, balanced and aggressive or balanced and conservative. Are you at all worried about getting maybe too much exposure to some of the stocks that are in multiple smartfolios? Same answer as Bitcoin.
Yeah, it's kind of same. The reason I think of that is it's not about having different stocks. It's about doing it differently.
Right.
So it's again, most managers, in the way we've all kind of come to understand the market, is we want exposure to different sectors. There's 13 sectors. We want to maybe have, say, take 1/13 of all of our money and put it into each sector, and we have a sector balanced portfolio. But those days are over, especially if a company like ours is using some kind of technology to manage the underlying symbols themselves. So in our case, yes, there's a lot of overlap between aggressive and balanced. But that's meant to be. And the reason is because we tend to want to be involved with things that work well with our algorithmic machine learning approach. There is no reason for me to try to pick some stock that we think might be a winner, but we have no data, no way to interpret where it's going to go and say that'll be the next winner. That is for Kathy Wood at ARK. And if you're willing to try to ride her, 200% up, then please be willing to understand that you can ride her 70% down that she had. And 70% down, Kathy Wood may be the manager of the day yesterday, but she would never, ever make it on Wall Street, ever. Not with that. No risk management. And hey, that's just my humble opinion. I'm not Kathy Wood. I obviously am not as well known as Kathy Wood, but nor would I hire her as a PM. And I might have just thrown out the best PM ever. But I could tell you, I would have gotten fired if I hired someone like that and they lost 70%. And that ain't happening.
Right. And just back to my question, it's not like we have 25% towards Apple in both portfolios or something like that either. It's a 3 or a 4% slice as well. Right. Back to this is a very Good question. Back to the core strategies. Brent asked, long 50% or in 100, how does that change for conservative, moderate, and aggressive? So I'm thinking, out of the 1 and 2% increments that are in those core strategies, is it all like the bit flip, or is it different in how it's managed?
It's different. If I got your question right, I look at it this way. Remember before the previous question, we were saying we take 50% of our money in aggressive and say 50% in balanced. Well, that means that if I had 100% in balanced, I might have a 5% position in, say, Microsoft.
Right.
But if I had 50% in balanced, then I'd have a 2.5 position overall in Microsoft on that portfolio. And if the other one was aggressive and it also had a 5% position in Microsoft, guess what? It's the same 5% I would have had in either one.
Yeah.
So you must think about it when you're dividing your money into different portfolios, that by taking it, you're cutting in half all the positions you have on your total wealth. It really works out the same way. All you're really doing is adding, when you add aggressive to say balanced, is you're putting in fewer symbols, because there's fewer symbols in aggressive, and they're also, there's higher percentages of like big movers like Nvidia.
Yeah.
So you're getting this new oomph to your overall portfolio of portfolios.
Yeah. I didn't ask the question very well, but basically I just wanted to make sure. And I knew this, but to clarify for Brent, it's the BitFlip Smartfolio, how iBit is managed is different than the little slices that are in the core strategies. Those are either 100% in or 100% out for that small position in each core strategy.
Right.
So
also the underlying strategy in that is different. In the BitFlip portfolio is different than the one we would use inside of aggressive or balanced. The underlying strategy of there is to trade with momentum. And inside of the kind of longer term portfolios of balanced and aggressive, it's just to have exposure to it because it is a decorrelator.
Yep. I'm going to run through a couple of these questions that are quick answers. So Suzanne's other one, does a custom portfolio get the same protections as the Smartfolios as far as AI input? The answer is yes. So some people might not even know that you can customize a portfolio. It's by no means required, but you can actually pick the stocks yourself, pick the allocations, and the AI will manage it. There's about 650 or so different stocks to choose from. It's not everything, but it's plenty to choose from as well at the same time. So yes, if you create a custom, it'll be managed the same way. Not to confuse anyone, but you can also buy stocks manually and the AI will not interfere in any way. Go ahead, Kelly.
Correct. And the only thing I can add to that is we're going to be changing that interface to make it a lot nicer as you build custom portfolios. I saw a demo of it earlier today. Believe me, it's going to be a lot nicer. Awesome. Than what we have right now. And that's necessary as we take on different kinds of clients that want this very particular feature. They want to build their own. Definitely. So look forward to the changes, any of you out there that are creating custom portfolios.
Perfect. Ethan, I'll look into this when we're done here, but he said I invested in BitFlip. It's not shown up in my list of Smartfolios that I own yet. I don't know when the order was put in. It could have been today. If so, it's not going to buy till the market opens tomorrow. If it was from a few days ago, I'll look into why. But just wanted to let you know I got your question. Roger, with the volatility of the stock market, what is the tax impact with the Smartfolios taking us in and out? Specifically, is there going to be more short-term capital gains burdens? We've done this one a few times.
Yeah, this is, by the way, it's always a good question, and I'll point that out right now. If you're an IRA or a Roth, obviously it matters not, right? Those things don't matter. However, if you are an investor and you get out of a stock and you have a regular individual account or an entity account, you get out of stock, yes, there is a tax consequence. If you made a profit, that will be treated, if you've held the stock for over a year, it'll be treated as a long-term capital gain. If it's been less than a year, it will be added to income. But know this, as the AI works and it gets you in and out of stocks, there is a tax consequence. Some of them are positive if you've made money, and some of them might be negative if you've lost money. They aggregate themselves and say, in the net, for example, at the end of the year, and you had a $100,000 portfolio and you made 8 trades, you got out of 8 different symbols, and this aggregate of those symbols was, say, you made $6,000 or 6%. Yes, you would have that as your income. But that is another, by the way, I feel a fallacy about the existing stock market. And let me dig into this a little more, because this really bears understanding. In the world of investment, if you're trying to manage risk, taxes are the issue of the account holder, not the issue of the manager. If the manager feels there is more risk to hold the stock than the tax consequence you might have, which could be as high as 37%, then what is the job of the manager? To call up the account holder and say, look, this stock looks like it's going down. It could lose another 20%. And if they lost the 20%, you have a loss. You don't show it on paper, but it's still a loss. You've lost money in your account. Oh, you didn't pay any taxes. Great. Personally, I'd rather pay the taxes on a profit and rather than watch my stock go down a toilet. I don't want to see a winner, for example, turn to a loser. And I think it's easier to manage your tax consequences. It's easier to manage your tax consequences when you look at the aggregate of it and say, no, I don't want to sell. I don't want to pay any tax. I'll just lose money in my account. That's where I think most money managers leave you. They leave you by saying, you don't have to worry about taxes or anything until you sell, but then they'll allow your account to go down 20, 30, 40%. In 2008, it went down 60% in the case of people that were in the Janus 20. Remember that one, folks? Do you remember the Fidelity Magellan? These are funds that lost 60%. The market was only down 54. They lost more. I think you'd rather pay a tax than watch your account go to that. So the news for us is we care about absolute return, and that is what really matters.
Yep. I think everyone invests. It boils down to you want to make your money grow and compound on itself. And I'm not trying to take what Roger said out of context, but I also don't want to make it sound like we make a bunch of trades either. Like Kelly said, we'd rather preserve the capital and pay a tax on the gain than ride a loser down or anything like that.
Perhaps one day with a little larger level, everybody, I could put these portfolios into an ETF, and you buy the ETF instead, and then the ETF can buy and sell all it wants inside of it, but you would have no tax consequence as long as you don't sell the ETF. Obviously, that's the most efficient way to do something like this.
Sure.
For the behalf of the account holder. Buy the ETF that has the strategies. You hold that. You don't take any K1 or loss. You don't get any 1099 profit, miscellaneous. You didn't do anything. You owned the ETF. And by the way, we are looking at that very thing.
Awesome. Joanne, first, welcome. So she's found out about us through the IRA Club, asking about training. So when this is done, just go to our YouTube channel. There's a playlist section, and there's one that says Intro to iFlip, I believe. There's a couple videos in there, but also feel free to just send us an email to mailbag@iflipinvest.com. I'll respond to you there, and I can even get you my calendar link, and I can walk you through the platform as well. Go ahead, Kelly.
Well, I see one more question I want to ask. I see a guy, Chad. What would happen to my smartfolio if, for whatever reason, iFlip went down the toilet? Yeah, he didn't say that, but I'll say that.
No, I know.
You remember, iFlip doesn't have your money. The clearing broker and ultimately a bank has your money. If iFlip went under, you still have a brokerage account. It is no longer attached to the iFlip broker dealer. It is tracked directly to the clearing firm. And even if the clearing firm went under, if the clearing firm went under, you would still have your money through FDIC. So, or sorry, is it, yeah,
SIPC.
FDIC, yeah. So, sorry, wrong institution. One's for a bank, one's for securities. So, very difficult. If our company were to go under, your account would still exist. The thing that would happen is that you wouldn't have any AI running it.
Right.
And then I would highly recommend that if you're really counting on AI, I would recommend closing an account if that should, God forbid, happen to this company.
Yep. We get that one a lot, and it's rightfully so, especially if you're new and you haven't heard of us or anything like that. You don't want to have your money disappear like I've seen way too often in various investments.
We're in a regulated industry, and it's the regulations, as much as they are onerous and bothersome, they're doing the right thing to protect individual accounts. And so it's very fair. That's a very fair question. And that is the reason why there is a regulatory agency. It's to protect this kind of thing and how it works. The design of our system is to protect the individual at all costs.
Perfect. I'm going to do a last call for questions here. We still have about 5 or so more to go over. They tend to all pile in at the end. I don't want to keep you guys for an hour. Kelly, you might be able to answer this one better than I can. Is it possible to invest in iFlip as a nonprofit organization? Sounds like maybe setting up an account, like a corporate account or something as a nonprofit. Can you do that?
I set up a nonprofit entity and then take monies inside the nonprofit entity and invest them?
I think so. If I'm understanding the question correctly. It says, is it possible to invest in iFlip as a nonprofit organization?
That is a question that a nonprofit organization certainly can open up a brokerage account. That I know. But if a nonprofit organization is making an investment in the markets, and like opening up an account, or as a nonprofit entity making an investment directly as like a investor in our company, I need more.
I think it says a brokerage account to use the platform. Let's just go with that.
To use the platform, my understanding is that a nonprofit entity, definitely, a lot of them are very large. They have to have brokerage accounts so that they can get beyond the interest of some of their free cash. Sure. So my understanding is there are many of them. There certainly was 20 years ago when I was at DB. So my answer is yes, but you know what? I recommend further.
Yeah, I actually didn't know that. I learned something today.
Because that was pre-Dodd-Frank. I don't know.
Awesome.
The answer.
Ethan with another question. If digital currency has speculative value because supply is limited, what gives digital real estate like metaverse long-term value since it doesn't have the same constraints? Wow, this is a deep question.
Ooh. I would normally say I want an easier one, but can you repeat the question?
Yeah. So if digital currency has speculative value based on the supply being limited, like Bitcoin, what gives digital real estate, like in the metaverse, long-term value since there's no constraints in the metaverse, quite frankly? I don't know enough about this, to be honest. I'm no help here. So.
Well, no, look, I like the question, but that is one that I really would need to contemplate further. It has never been posited to me, so I don't have a quick answer off the top of my head, and anything I would say would be speculative. I want to hold back that question, and so that I can probably write up a response and answer that later. I got to think about that one.
Yeah. Honestly, I feel like it's so new that I would kind of feel like in crypto, in a sense of like, can you call yourself an expert when it's been around only, a certain amount of time? I feel like a lot of people would have speculative answers to it.
Crypto actually, though, is a cryptocurrency. If it's a currency and it could be used and one day become fungible. Yeah. In other words, I can go rent a car with it or buy a car with it, which at some places you can. Digital real estate, think of it, it's not fungible. I've heard about a long while back. Remember the NFTs craze?
Yep.
In the NFTs, you would buy You would create an NFT around a property, a piece of real estate, or a condominium, and you would sell pieces, or sorry, a rental building, and you would sell pieces of that out digitally. I see that as tethered to the real estate itself. However, I think the pricing of something like that could be erratic, and it could be whatever the market will pay. I have to really think about that one further.
Sure.
I'm going to hold off answering that.
Please do. Brent, I'm sorry I probably didn't answer the question you were kind of asking. Some of these are hard to speculate what's being asked. Feel free, I know you have my information. Feel free to reach out to me and we can go over it verbally. I was trying to explain the differences as to how iBit is managed, for lack of a better word, in the balanced and aggressive smart folios, whereas BitFlip is its own smart folio that's, I would say, very unique in that iBit is the only thing that's in there, and half of it is managed by the AI, half is just in a buy and hold of the symbol. I don't know if you have anything to add, Kelly, but maybe you're understanding him
No,
better
not
than I
on
am.
that one. No, I think I see two more questions I can answer
Yeah.
briefly before we got to jump.
And Boris, did you say NVIDIA is going to go down? If so, why?
That's one. Here's the reason. It's like, again, it doesn't matter what the dynamics of any particular stock is, including the obvious value of NVIDIA and AI. If the market sells off, they will sell NVIDIA. You always sell, when people sell, they sell their best thing. May not be the wisest thing to do, but that's what they do. In other words, in a down market, all things get sold. All things are correlated. Bonds, stocks, Bitcoin. So if we get into a true sell mode, you can expect NVIDIA to lose, and it will lose more than the market. And the reason is because it is very liquid and it has had the biggest jump. So I suspect if the market corrected 20% or even 10%, NVIDIA would correct 20 to 25%. Might be the greatest bargain in the world, but it won't matter. They will sell that because it's handy. And remember, when people are scared and we start to correct, people sell their best things, not their worst. And the other question is, can AI help clients find the best mix of portfolio? No, AI doesn't do that. AI learns on the information behind the movement of an individual symbol. What that question is referring to is to finding the best mix. That actually is a kind of an efficient frontier question. And that is the way you do that. And you can get a spreadsheet on the internet and you build a correlation matrix where you do the auto correlations between the different stocks against the S&P. That is how you find the optimal mix between covariances and variances to say of all the individual stocks inside of a portfolio to find the best mix. And so when you add a new stock and you create it, it can do that on the fly. There's spreadsheets on the internet you can download and do that with. So no, AI doesn't do that. That is done behind the scenes by recognizing what's best of the symbols that we can work well with. And then we aggregate them. We've set up, and then from there, we can set up optimization, but not before.
Yeah.
Because we don't know before.
More so, you're using it to optimize the portfolio construction, I guess you could say, right? Like when we changed stocks out a couple weeks ago or months ago.
That's because optimally, if we took one out and added another in, the nuances of the way the machine learns on this new stock adds greater sharp to the new portfolio than if I just kept the old stock in.
Sure.
That's the reason. It's a very complex question. It's a good question, but it's not so simple.
Sure.
But it really ultimately will always boil down to it's covariance divided by variance. That is actually the answer, and that's what gets optimized.
Awesome. Well, speaking of good questions, Kelly, this is now your time to pick your favorite. As a reminder, Kelly's going to pick someone to be our winner tonight. and the winner is going to get an Amazon gift card, $25 from us. All you have to do is use the platform and use the Smartfolio, and just reach out to us at mailbag@iflipinvest.com just to share a screenshot of what you're invested into, and then someone from our team will email over the how you basically redeem the gift card. So Kelly, who's our winner tonight?
A lot of good questions.
There are.
I always, just so everybody knows, I care a lot about taxes. So it's not just making money in doing and having a risk-adjusted return, and we just care about having the best risk-adjusted return we can. I think the question regarding the one that gets asked frequently, but it hasn't been asked on the AI circle is, when you buy and sell stocks, what are, the tax consequence of that? And that, I have to say, that's the best one tonight, only because that was the reason why everybody invests in large hedge funds. When you have wealthy endowments and or states or teachers unions, they invest in this space. They know that people are going to trade, and they do bear tax consequences, but they're investing for an absolute return.
Sure.
Who is going to make the most money year over year and accept the tax consequence of whatever that is, knowing that they got the best manager they can get? So that question should frequently be asked. But those people that know and run large money, it's never a question. It does matter at this level, and I think it always bears answering at our level, which is essentially we're retail. And so it's a good question.
Awesome. Well, it sounds like Roger's our winner. So Roger, congratulations. I'll put the slide back up so that you can just be reminded as to where to go. Give me 1 second. There we go. So just email us at mailbag@iFlipInvest. Send us one of your accounts and just a screenshot, or you can send us the account number. That's all I think that we have to cover for tonight. I'm not going to spoil the surprise, but next AI Circle, we do have a nice surprise for you guys. I'm not going to say any more than that. But thank you guys for joining us as always. Kelly, thank you for your insights, and kudos to everyone in the chat who put in a question, because I think this was probably a tough one to pick a winner from. There's a lot.
It was. I mean, I liked a couple other questions as well, but thank you, everybody. I'll see you in 2 weeks. Thank you so much for attending.
Awesome. So next one will be the 24th, same time as always. So we have next week off, and then we'll be back. So have a great rest of your week, everyone. Enjoy the Masters if you're a golf fan like Kelly and I, and we will see you again in a couple weeks. Take care.